When markets collapse, most investors panic. They liquidate positions, lock in losses, and convince themselves they're protecting capital. But here's the reality. While the herd is selling in fear, rational investors are executing a completely different strategy. They're treating systemic volatility as a scheduled rebalancing event, not a crisis. The difference between these two approaches compounds over decades. This video gives you the framework to stay rational when everyone else loses their mind, so you can actually exploit panic instead of becoming another victim of it. Let me explain what happens when markets fall hard and fast. Fear triggers automatic selling. People see their portfolios drop 20, 30, 40%, and something in their brain just breaks. Logic shuts off. This is systemic. When volatility spikes, it exposes who has conviction in their thesis and who doesn't. The majority don't have conviction. They own assets because they were told to, or because everyone else owns them, or because they followed some algorithm. So when bloodletting arrives, they panic sell at exactly the wrong time. Here's what matters. Panic creates mispricing. It doesn't create fundamental collapse. A quality business trading at half its intrinsic value doesn't suddenly become worthless just because the market is in freefall. The business is still generating cash flow. The competitive advantages still exist. The customer base is still there. But the price dropped by 50% because emotional actors needed liquidity and safety. That's your opportunity. The key insight most investors never grasp is this. Panic is temporary, but fundamentals persist. Markets will recover. Assets will reprice higher. And if you're prepared, you'll have accumulated them when prices were low, not when they were high. This is how you actually exploit it. You treat volatility as a scheduled rebalancing event instead of a disaster. Step 1. Before panic hits, identify your high-conviction assets. Know your thesis for each holding. Write it down. This isn't guessing or hoping. This is clear reasoning about why that asset will deliver returns over your time horizon. Step 2. Set target allocation percentages. If you decide equities should be 60% of your portfolio, then that's your target, not a suggestion. A target. Same for bonds, commodities, cash, whatever your strategy demands. Step 3. When panic arrives and volatility spikes, execute mechanically. Your equities drop from 60% to 40% because prices fell? Buy back to 60. You've already decided this is the right allocation. The panic didn't change your thesis, it just changed the price. So, you execute the rebalancing you planned. Step 4. Maintain dry powder. Keep cash reserves specifically for this scenario. When bloodletting happens, you have capital ready to deploy. You're not scrambling to raise money at market bottoms. You already have it. The discipline is simple but brutal. Stick to your allocation targets regardless of headline noise. Ignore the financial media catastrophizing. Ignore the sentiment collapse. Your job is to rebalance toward your targets because that's what rational capital allocation looks like. Here's a concrete example. Your target is 60% equities, 40% bonds. A crash hits. Equities fall 50% in value while bonds barely move. Now you're at 45% equities, 55% bonds. You're underweight your high-conviction thesis. So you sell bonds, buy equities, and rebalance back to 60-40. You just accumulated equities at half price while others were liquidating in panic. This isn't market timing. This is systematic rebalancing that turns fear into opportunity. And the result is straightforward. You accumulate assets when prices are low. The framework only works if you have the right mentality going in. You need to separate signal from noise. Market crashes are noise. Business fundamentals are signal. Your job is to ignore the noise and focus on asset prices relative to intrinsic value. Here's the paradox. Staying calm during chaos is how you build wealth faster than investors who panic. Volatility is the price you pay for long-term returns. Treat it as cost, not catastrophe. Document your thesis before panic hits so you can refer back to it when emotions rise. Rational allocation isn't about being fearless. It's about being systematic. Market panic is a feature, not a bug. If you're prepared, it's your advantage. Subscribe for more on navigating volatility with conviction, not emotion.